Gold just pumped $120 in 2 hours. 2 hours. Not 2 days, not 2 weeks. 2 hourly candles on the chart, 50.50 to 51.70, straight up. And the reason it happened is the same reason everything has been happening in this market for the last 5 weeks. The dollar. The dollar topped out at 99.50 and started crashing. And the second it started crashing, gold launched. Like a switch got flipped, dollar down, gold up, instantly. If you have been watching my channel, you already know why. If you are new here, buckle up, because what I am about to break down in this video is going to change how you look at every single candle on the gold and silver chart from today forward. And I need to tell you something about what is coming on March 10th and 11th, because the gold chart and the dollar chart are both pointing to the same 2 days, both of them. Something is about to resolve, and when it does, the move is going to be massive. I am going to show you exactly what the charts are setting up, and why those 2 days matter more than anything else right now. That breakdown is at the end. Do not miss it. Now let me walk you through what happened today, because the chart pattern that played out is textbook, and once you see it, you will see it everywhere. Gold was crashing. Monday, we had that massive crash from 5,400 to 5,000. Dollar pumped from 98.50 to 99.60, and gold got destroyed. I broke that down in my dollar video. Since Monday, gold has been grinding sideways. It put in what we call an M pattern on the chart. 2 peaks with a valley in the middle. The M pattern is bearish. It tells you sellers are in control. Gold made the first peak, pulled back, made a second peak that could not get higher than the first one, and then broke down. That M pattern crash took gold from the mid 5200s all the way down to 50.50. But here's what happened next. Gold hit 50.50 and it bounced. Then it pulled back again. Then it bounced again from roughly the same level. That is a W pattern. 2 bottoms with a peak in the middle. The W is the opposite of the M. It is bullish. It tells you buyers are stepping in at that level and they are not letting it go lower. Gold carved out an M on the way down and a W at the bottom. That is a complete pattern. Crash, find the floor, test the floor, bounce. And the breakout from that W pattern is what caused the $120 pump in 2 hours. Now here's the critical part. The W breakout was a breakout from the short-term bearish pattern, the pattern that has been in place since Monday's crash. Gold broke above the neckline of the W and it moved fast. $120 in 2 candles. It tells you the energy that was being compressed during the consolidation released all at once. And it released to the upside. That is significant. But I need to be honest with you. This does not mean gold is bullish again. Not yet. This was a short-term pattern breakout inside a larger bearish structure that started with Monday's crash. Gold is still below where it was before the crash. The overall trend from Monday is still down. What this W breakout tells you is that the selling pressure is losing steam. The bears are getting tired. The buyers are showing up at lower levels. But we have not flipped bullish yet. We are in a transition zone, and that transition is going to resolve in the next few days. But before I show you when and how it resolves, I need you to understand the context of what we are living through right now, because this is not a normal market. This is not a normal year. And if you do not zoom out for a second, you're going to miss the bigger picture. 2026, we are barely into the 3rd month. March 6th today, and look at what has already happened. Gold hit an all-time high above 5,600. Silver hit an all-time high at 121. Traditional stock markets hit all-time highs at the same time. That has never happened before in market history. All 3 asset classes peaking together is historically unprecedented. Then the crash came. Gold crashed 21%. That kind of crash has not happened in gold in 2 to 3 decades. Silver crashed 45% from its all-time high to $65. Almost half its value gone in weeks. A full-scale war broke out between the US and Iran. Not a proxy war, not sanctions. Actual military strikes, hypersonic missiles, a submarine sinking a warship off Sri Lanka. The Strait of Hormuz got shut down with traffic dropping 70%. The dollar pumped from 95 to 99 at the worst possible time for precious metals. The Epstein files got released and the world saw things nobody expected. 15% global tariffs started. The Fed got completely paralyzed between inflation and recession risk. And we have not even finished the first week of March. I told you before March started that this was going to be the most volatile month of the year for gold and silver. Monday proved it. Gold crashed $400 in a day. Silver lost $19. Then today, gold pumped $120 in 2 hours. This is not normal. This is a market being stretched to its absolute limit. And it is not done stretching. What I'm about to show you with the dollar chart and the March 10th convergence will explain exactly when the next massive move happens. Let me show you why the dollar is the key to everything. Because the timing of the gold pump and the dollar crash is not a coincidence, it is the same trade. Gold bottomed at 50.50 today. Pull up the dollar chart at the exact same time. The dollar topped at 99.50 at the exact same moment, to the minute. Gold's low equals dollar's high. That is the inverse correlation operating in perfect sync. When you see that level of precision in the timing, it tells you that the algorithms and the big money are trading gold as a function of the dollar. They are not looking at war headlines. They are not reading news about Iran. They are watching the dollar index tick by tick, and when it turns, they hit the buy button on gold. That is what moved gold $120 in 2 hours. Not a headline, not a news event. The dollar reversing from 99.50. And this is why I keep telling you that if you want to understand gold and silver, you have to understand the dollar first. Gold did not decide to pump today. The dollar decided to drop, and gold reacted. The dollar is the driver. Gold is the passenger. Until that dynamic changes, and it will change eventually, you need to watch the dollar chart more than you watch the gold chart, because the dollar chart will tell you what gold is about to do before gold does it. Now here is where the dollar is right now and why it matters so much. The dollar topped at 99.50. I told you in my previous video that 100 was the major resistance. The dollar could not even get there. It topped at 99.50 and reversed. Think about what that means technically. The January high on the dollar was above 100. This rally from 95 could not reach the January high. It fell short by 50 cents. That is what we call a lower high. And lower highs are the first sign that a trend is weakening. When a rally fails to reach the level everyone is watching, it sends a very specific message. The buyers are losing conviction. Every trader on the planet had their eyes on 100. The fact that the dollar could not get there after 5 weeks of rallying tells you that the buying power behind this dollar move is fading. It ran out of gas 50 cents short of the finish line. And when the dollar reversed from that lower high, gold did not hesitate for a second. $120 straight up in 2 hours. The market was waiting for this crack. And the second it appeared, the buyers pounced. Right now, the dollar is trading below 99. That is important. If the dollar stays below 99 and starts making lower lows from here, that confirms the 5-week rally from 95 to 99.50 is over. And if that rally is over, gold and silver are about to have a very good stretch. But if the dollar holds above 98.50 and pushes back toward 99.50 for another attempt, then we are still in the range, and the consolidation continues until March 10th. Welcome to the hidden economy. If you are new here, hit subscribe and hit the hype button right now. I called the dollar resistance, I called the gold crash, I called the inverse correlation. If you want to stay ahead of this market, this is where you need to be. Now, let's keep going. Now, let me show you the COMEX delivery data. Because while everyone was watching the price action today, the banks were doing something very interesting behind the scenes. Pull this up on screen. COMEX Gold Futures Delivery Notice. March 5th, 666 contracts issued. 666 stopped. Look at who is on each side. Wells Fargo issued 516 contracts. That is Wells Fargo putting out 516 contracts worth of physical gold for delivery. Barclays issued 150. On the stopping side, Bank of America stopped 543 contracts. 543. JP Morgan stopped 94. BNP Paribas stopped 24. HSBC stopped 5. Month-to-date total is now 4,791 contracts standing for delivery. Let me translate that. 543 contracts for Bank of America. Each gold contract is 100 ounces. At roughly $5,100 an ounce, that is about $277 million. Bank of America just took delivery of $277 million worth of physical gold in one day, while the price was crashing. While everyone on social media was panicking, Bank of America was signing checks for $277 million of physical metal. JP Morgan stopped 94 contracts. That is another $48 million of physical gold. Combined with Bank of America, that is over $325 million of physical gold taken delivery of by 2 banks in a single day. $325 million. And month to date, we are at 4,791 contracts standing for delivery in March. At current prices, that is roughly $2.4 billion worth of physical gold demanded for delivery this month. $2.4 billion. Does that sound like a market that is collapsing? Does that sound like the smart money is running away from gold? The price is going down and the deliveries are going up. The price is going down and the banks are writing bigger and bigger checks for physical metal. That contradiction between the paper price and the physical demand is the most important thing you can understand about this market right now. And notice who is on the issuing side. Wells Fargo issued 516 contracts. Barclays issued 150. Those are the firms putting metal out for delivery. And who is receiving it? Bank of America and JP Morgan. Metal is flowing from some banks to other banks. This is not retail selling. This is an institutional game. The metal is changing hands between the biggest financial institutions on the planet, and the direction of flow tells you who thinks the price is going higher. The firms taking delivery are betting on higher prices. You do not take delivery of $325 million of physical gold if you think the price is going lower. That is not how banks operate. And this is the same pattern we have seen in silver. Banks crash the paper price. Retail panics. Banks take delivery of the physical at the lower price, every single time. The delivery data does not lie. It is sitting right there on the CME website. Now I need to talk about silver because the title of this video says Silver Next, and I meant it. Silver is doing something right now that I have been waiting to see. It is coiling. If you look at the silver chart, the range is getting tighter. The highs are getting lower, and the lows are getting higher. That is a compression pattern. A triangle. And triangles resolve with explosive moves. Silver went from 96 to 77. That was the initial range after Monday's crash. But since then, silver has not retested 96, and it has not retested 77. It bounced off the low, and it got rejected from a lower high. Then it bounced again from a higher low and got rejected from an even lower high. Each swing is smaller than the last. The range is compressing, like a coiled spring getting wound tighter and tighter with every passing day. And here is what makes silver's coil so dangerous in both directions. Silver is a leveraged instrument. It moves in multiples of gold. When gold moved $120 today in 2 hours, silver moved, but not as much as you would expect. It is being held back by the compression. The energy is building inside the triangle. And when that triangle breaks, the move is going to be amplified by silver's natural leverage on top of the breakout momentum. That is a double accelerant, breakout energy plus leverage multiplier. The last time silver coiled like this and then broke out, the move was over 15% in 3 days. And the setup right now is even tighter than it was then. Here's why I think silver moves after gold. Gold leads. That is how it has always worked. Gold breaks out first and silver follows. But when silver follows, it does not just match gold's move, it amplifies it. If gold breaks out 10% from here, silver could move 20 or 30%. That is the leverage effect. And with silver coiling in a tighter and tighter range right now, while gold just broke out of its W pattern, the setup for a silver move is getting closer by the hour. But I need to be clear. Silver has not broken out yet. Gold broke out of its short-term pattern. Silver is not. Silver is still inside its compression range. And until it breaks out, I cannot tell you which direction it goes. If the dollar reversal holds and gold keeps pushing higher, silver will follow to the upside, and it will be explosive. If the dollar finds support and bounces back above 99, silver breaks to the downside and we revisit the lows. The dollar decides, not silver. Watch the dollar. Now let me talk about what is coming on March 10th and 11th, because this is the part I told you to stay for. I have been looking at the gold chart and the dollar chart side by side, and both of them are converging on the same date range, March 10th and 11th, Tuesday and Wednesday of next week. Here is why. Gold has been in this consolidation range since Monday's crash. The swings are getting smaller. The pattern is tightening. When you draw the upper trend line of the lower highs and the lower trend line of the higher lows, they converge right around March 10th and 11th. That is where the triangle apex is, the point where the range gets so tight that the price has to break one way or the other. It cannot stay compressed forever. And the apex of this triangle lands on Tuesday and Wednesday of next week. Now, pull up the dollar chart. Same thing. The dollar has been making lower highs since 99.50, and it has been making higher lows since the recent dip below 99. Those trend lines also converge around the same dates, March 10th and 11th. Both charts are pointing to the same 2 days. When two inversely correlated assets both show pattern completion on the same date, that is not a coincidence. That is the market telling you something. It is telling you that the period of consolidation and confusion is about to end. A decision is coming. Gold goes up and dollar goes down. Or gold goes down and dollar goes up. One of those two things happens on or around March 10th and 11th. And given how much energy has been compressed into these patterns over the last week, the move is not going to be small. It is going to be the kind of move that sets the trend for the rest of March. And here is what makes those dates even more significant. The economic calendar. US CPI data drops on March 11th, Consumer Price Index. That is the single most important piece of data for the dollar and for gold right now. If CPI comes in hot, inflation higher than expected, the dollar rallies because the Fed has no room to cut. Gold drops. If CPI comes in cool, inflation easing, the dollar drops because rate cuts come back on the table. Gold rips higher. The CPI report lands right at the apex of both triangles. That is not just a technical convergence. That is a technical and fundamental convergence on the same day. The chart pattern reaching its breaking point on the exact day the most important data hits. That is the kind of setup that produces the biggest moves of the year. And it is 4 days away. Now here's what decides which direction. If the dollar breaks below its recent support and starts a new leg lower, gold breaks above its triangle to the upside. The first target becomes 5,300, which is the new resistance level. 5,300 used to be nothing. Now it is the wall. The crash moved the resistance down from 5,400 to 5,300. If gold clears 5,300 with momentum, the path back toward the all-time high opens up, and silver follows with a leveraged move that could take your breath away. If the dollar bounces off support and breaks back above 99.50, gold breaks below its triangle to the downside. The 50-50 level gets retested, and if 50-50 breaks, we are looking at another leg lower toward the 4,500 zone. Silver in that scenario revisits the mid-70s. Both scenarios are on the table. The data decides. Not me, not you, not the headlines. The dollar chart decides. And the dollar chart says the decision date is March 10th and 11th. And I know this has been an insane ride. I know some of you bought gold above 5,400 and watched it crash to 50-50. I know some of you bought silver in the 90s and watched it drop to 77. I know what that feels like, watching your screen turn red while the news is telling you the world is falling apart. And then today, gold pumps $120 and you feel that rush of hope and you are not sure if you should feel relieved or scared that it might crash again tomorrow. That is normal. That is what extreme volatility does to people. It makes you emotional. It makes you reactive. It makes you want to chase the pump or sell the crash, and both of those instincts are exactly wrong. The people who win in markets like this are the people who stop reacting and start reading the data. And the data right now is not confusing at all. The data is crystal clear. The dollar drives the price. The charts are converging on March 10th and 11th. The banks are taking delivery of hundreds of millions of dollars of physical metal at crash prices, and silver is coiling for a move that could be historic. That is what the data says. Everything else is noise. Here is what I want you to take away from this video. 3 things. 1. Gold broke out of its short-term bearish pattern with a $120 pump in 2 hours. That is significant because it shows the selling pressure from Monday is losing steam. But I need to be honest, we are not bullish yet. This was a short-term pattern breakout inside a larger bearish structure from Monday's crash. Gold is still below where it was before the crash. What this tells you is we are in transition. The bears are getting tired. The buyers are showing up. But the full reversal has not happened yet. 2. The dollar topped at 99.50 and could not reach 100. That is the first real crack in the dollar rally that has been crushing gold and silver for 5 weeks. The dollar made a lower high. If it stays below 99 and makes lower lows, the rally is over and gold-silver rip. If it bounces back above 99.50, we go lower. Dollar decides everything. Full stop. 3. March 10th and 11th, both charts converging. Gold triangle apex, dollar triangle apex. CPI data on the 11th. Technical and fundamental convergence on the same dates. The consolidation ends there. The next major trend starts there. Whatever happens on those 2 days sets the direction for the rest of March and potentially the rest of the quarter, 4 days away. Watch the dollar, watch the triangle, and be ready. Because when this thing breaks, it is not going to give you time to think. It is going to move and you are either positioned or you're watching from the sideline. Drop a comment. Tell me which way you think it breaks. Dollar up or dollar down? Gold up or gold down? March 10th and 11th, make your call. I will pin the best predictions and we will come back next week and see who got it right. Share this video. There are people in your life who own gold and silver and they are confused about why it pumped today after crashing all week. This video explains the mechanics. Help me reach them? If you are new here, go watch the dollar video from yesterday. It explains why the dollar is driving everything and why gold has been crashing during a war. Then come back here and this video will make even more sense. Together, they give you the complete picture. Links in the description. This is the hidden economy. Gold pumped $120 in 2 hours. The dollar cracked at 99.50 and could not reach 100. Banks took $325 million of physical gold in 1 day. Silver is coiling tighter than I have ever seen it. And March 10th is 4 days away. CPI on the 11th. Technical and fundamental convergence. The decision is coming. Whatever direction this thing breaks, it is going to be fast and it is going to be big. Follow the data, not the noise. I will see you on the other side of March 10th.